enhanced consumer protection, the creation of tools for financial crisis, and increasing international cooperation. In your opinion, which of these elements should be prioritized? Mr. Maffei.
Well, I think that given what we've just come through in this country and the lack of regulation on the unregulated and oversight and the dismal position that we found ourselves in when the smoke cleared in terms of the funding of our reserve for FDIC insurance, et cetera. I think the oversight has to be the first priority, and I think the systemic risk to our whole system has to be priority.
Mr. Roberts.
Madam Chair, I would think also that the issues surrounding systemic risk and surrounding those organizations that previously were unregulated or underregulated are the most important items to address in those items that you have talked about.
Thank you. Mr. Hampel.
I would agree with those comments. So one thing that Congress needs to be concerned about is right now there's a fervor to do regulatory reform because we are still in the latter stages of the crisis, and that's perhaps not the best time to make significant changes when we're so caught up in the moment. The risk is if we wait too long, by the time we've had enough time to study it properly, there won't be sufficient impetus to do it. But I would agree that systemic risk must be dealt with, and also extending some form of regulation to the currently unregulated.
Okay. Mr. Maloney.
Again, I think the systemic element has to be dealt with as a high priority item. I would also maybe go to the other end and start with the consumer protection and move up from there. Between those two, I think you can cover a lot of ground towards making it a more effective and fair playing field.
Okay. Ms. Donovan.
Madam Chair, I would say our position would be the systemic risk, but also the regulation of the unregulated, pretty much as Mr. Hempel and the other members of this panel have said.
Thank you. Mr. Roberts and Ms. Donovan, during times of financial duress, higher capital requirements can provide a cushion for lenders. But these increased levels can also restrict a bank or credit union's ability to make loans to small firms. Can you talk about how higher capital requirements might impact your small business lending practices?
I think that's really a very good question. In my testimony, I spoke about the fact that in 2008, my bank paid $75,000 in FDIC insurance. 2009, that number could be anywhere between $550,000 and $700,000. When you start looking at those numbers, what in turn you see is that means profitability. Money that is going to go into the capital of our organization is going to be reduced by $475,000 to above $600,000. In turn, what that relates to is capital to support loans that might be available supported by that capital could be anywhere from $5 to $7 million less. That is certainly going to impact our ability to lend to small businesses as well as customers as a whole. As those capital requirements get to be tighter, it certainly does provide additional safety net, but one has to keep in mind that it also is going to restrict lending.
And then there will be other people that will say that the risk to taxpayers and depositors go down.
My response to you is I think there's a practical level of capital that can satisfy both sides of that particular equation. We talked earlier, I think at the prior panel, that some people were leveraged 30 to 1. That's probably too much. Is 5 to 1 too little? I would suggest that it is. I think there is a capital level that is a reasonable balance that continues funds to be able to be lent and still provides that safety to the taxpayer.
Yeah. Ms. Donovan.
Madam Chair, most credit unions today have sufficient capital. We have good capital on hand. Unfortunately, the artificial cap that is on member lending is what is refraining us from lending that out. I'm a very small credit union, as I noted. We do not have hardly any member business lending, very little. However, we do have the capital to lend to the small businesses in our community, and most credit unions do have that at this point.
Okay. Mr. Maloney, up until the financial crisis, the economy experienced a decade of relatively solid growth. And during this time, we saw an explosion of financial innovation and all of the products that went with it. Are you concerned that the proposed regulations might reverse this trend of financial innovation?
Good question. Yes is the short answer. But I probably would like to also state that I think that it's very possible that with the creation of these innovative products, we may have gotten ahead of ourselves and had things that people really didn't fully think out and sold them to clients who didn't have a clue. So maybe, you know, the answer is yes, I want to have that ability, but I also want to make sure that the people involved who are on the buying and the selling side of it know the products that they're dealing with.
Okay. Mr. McPhee and Mr. Hampel, addressing systemic risk will be an essential element of the reform proposal. As you noted in your testimony, community banks and smaller and less interconnected than large international are much less interconnected than large and international institutions. Even so, community banks can still transmit risk into the financial system. In light of this, should community banks or small credit unions be subject to systemic regulation?
Madam Chair, speaking for credit unions, my understanding of systemic risk is such that if even the largest 10 credit unions were all to get into extreme difficulty at the same time, it would not spread to the rest of the financial system. So I don't think that credit unions could ever be the source of systemic risk just by the nature of their size. However, credit unions, because they are connected and users of the rest of the financial system, can be victims of the systemic risk of other institutions, and that's why we're interested in the issue.
Okay, I have other questions, but I'm going
to pass, Madam Chair, for now.
Okay. Mr. Westmoreland.
Thank you, Madam Chair. Let me say,